All right. Hello, everyone. Thank you for tuning in. We're going to wait a few minutes just so that we can go live on all the different platforms. Hello. Got the chat up there. Go ahead and drop a comment in there if you're tuned in. Good morning to everybody. Good morning. Good morning. For those that just hopped on, we're just going to wait a few minutes here. We can make sure we go live on all the platforms, give everybody a chance to tune in. Got a good topic that we're going to go over today, as you can see on the screen. Definitely something that people have a lot of questions about. So it's going to be a good show here today. Welcome, welcome. Those tuning in, good morning. All right. Thank you, everybody, for tuning in. Deborah asking the questions. Yes, we can. We're going to talk about that today. Okay, I think we can go ahead and get started then. Let's get this thing rolling. So let me take off the chat here. All right. Welcome, everyone. My name is Kyle Hiersche. I am the COO of the Mortgage Calculator, and joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. So what we do here every day is go through the rates for the different programs that we offer, some of the programs that we offer, and then we also do a deep dive into a different subject each day. So Nick will go through the rates here in just a minute. And then after that, we'll talk about land loans. And I know I get a lot of questions about this. This is definitely a special product and something that people have a lot of trouble with. It's definitely something that hardly anyone offers. But we do have outlets here for that at the Mortgage Calculator. And Jose is going to talk about that later. But for now, so that we can see the rates every day we go through this and you can see the rates going up and down. It's great to see how the market is reacting, and we have a great tool to do that with. So I'll go ahead and pass it over to Nick so he can pull up our quoting tool and give you guys an indication of the rates for a bunch of the different programs that we offer. So go ahead there, Nick.
All right, let me pull up my tool. Give me a second, switch on my screen. And here we go. So thank you, Kyle. This is our live rate tool. This is for our mortgage professionals only. So again, if you want a detailed quote, please get with one of our 300 plus loan officers, and they can give you a full breakdown loan estimate on your deal. We are licensed in 21 different states for primary, secondary homes, and we can do our business purpose DSCR commercial type loans in almost every state. So please get with our team if you need a full quote, but let's check out the live rates today just to see what the markets are doing. So we'll use our pricing tool here. We'll set up a basic scenario, and we're first going to go through our conforming conventional options for a primary home. Then we're going to go to our FHA options for a primary home, which is typically the next best option for most borrowers. And then we're going to go over our expanded guidelines in non-QM. We have over 4,500 loan programs beyond conforming and FHA for our borrowers that may need a little bit of extra help. For VA, we can quote that instantly, but not everybody qualifies for VA, so we appreciate our vets. Let us know if you'd like a quote, if you qualify with your certificate of eligibility, and we can get that out in a couple minutes. And same with USDA, since only certain properties are eligible, we won't do that live today, but if you are looking in an area, let us know. We can quote that in a couple minutes. But let's start off with our basic scenario for conventional and see what we have today. For all our scenarios, we're going to do an 80 LTV, 80% loan, 20% down payment example. 400,000 loan amount is up here. That's going to be our loan amount for all the examples. 99 price, that means one discount point cost. So the computer's going to try to find the best rate for one discount point cost. Most of our customers are asking to buy down the rate a little bit. So that's typical of our typical requests. We're going to do conforming at first, purchase, 30-year fixed, pretty standard. We're going to do primary, single family, 1 unit, Florida, Miami-Dade, since that's where our office is based. And for all of our examples, we're going to use a 760 estimated FICO score and an estimated 40% debt to income ratio. So these are going to be all our settings for all our examples, but let's check out what the rates are today. So what happens every morning is these specialty programs pop up. If you are under an area median income or in a census tract, these programs for Home Ready and Home Possible are eligible. But let's cruise down to the first standard option that everybody can use, so we can compare apples to apples. All right, looks like the first option here is a confirming 30-year fix. So this is the first standard option, 6.875 rate for 0.875 in discount point cost. You can see here. So it's about the same it was yesterday, actually a little bit lower. We should see some rates hopefully go down a little bit today. Again, it's just on February 23rd, just after 11 a.m. So this is the first rates for today. Hopefully, as the markets start to react, hopefully yesterday they overreacted a little bit and we can see them go down. But it's gone down a little bit, I believe, since yesterday's show. We also have this one. It looks like, actually, this is the one I would quote my customer here. Same rate for a little bit lower cost, 6.875 rate for 0.75 in discount point cost. So that would actually be the option I would choose. But now let's check out what we have for FHA if our borrower, for some reason, may need a little extra help. So we'll do the same scenario, 80 LTV. Switch this over to FHA, and we'll keep everything else the same. But just keep in mind, FHA does allow our borrowers to usually have a higher debt to income and some other flexibility on the guidelines. So typically that's our second option. And actually, the great news yesterday was that FHA just reduced its mortgage insurance rates. So actually, FHA is an even better option today than it was yesterday. Since this just got announced, all the loans after April will have a new MI factor. So this is actually still using the old MI factor. But like I say every morning, we got a rate here for 6% rate, 1 discount point in cost. Ooh, actually, this would be the better one. 6% rate, 0.5 in discount point cost. And you see here the APR of 6.89%. And keep in mind, come April, when we're able to push the new MI amounts for FHA, this will go down, because the APR does include the monthly mortgage insurance premium and the upfront mortgage insurance that are applied to FHA loans. So FHA definitely got a boost today, so keep that in mind for all your deals. FHA is very viable, especially after the news yesterday. Now, as you can see, we have a ton of FHA options. There's some specialty ones as well. But if a borrower doesn't qualify for FHA or maybe needs a little more help, a little more income, a lot of lenders do not have options, but this is where we love to help out at the Mortgage Calculator. We have over 4,500 loan programs under expanded guidelines. This is what we call non-QM, and this allows us to use alternative income documentation. So we'll set up the same scenario, 80 LTV purchase, everything else the same, 30-year fixed primary, but you see now we have a different option here that pops up for income verification. So if our customer, our borrower can't qualify for what they need for full doc, which is what we use for 2 years tax returns for conventional, conforming, FHA, for all the other types of loans, we have dozens of other options here. So if we can't go full doc or we need some other alternative income, we can go 1 year alt doc, 2 year alt doc. We can use assets without even any employment. We can do business bank statements, 12 and 24 months, typically the most popular. When we do investment properties, we can do our DSCR loans. These are amazing. And our most popular program by far for non-QM is our personal bank statement, 12 months. And typically this is for our self-employed borrowers. So we're going to check the self-employed box, and we're going to use 12 bank statements from our borrower to determine their debt to income ratio of 40% in order to determine that they can pay that loan back, obviously. So a lot of times our self-employed borrowers maybe file taxes and have write-offs, and their full documents income, their 2-year tax return income, isn't quite enough to get the house. So that's where we love to use this. So these options not only allow borrowers who would not qualify at all to qualify, but allow our borrowers especially our self-employed borrowers who may need a little extra income to use those alternative sources for income. So you see here our non-QM programs are going to have higher rates typically, but you see they're pretty comparable to the conventional, and reminder that these would be for people who would not otherwise qualify. So not that much higher rate. We have a 7.625 rate here at the top for 0.625 in discount point cost. So pretty comparable to conventional now. And as we do this show every day, you see that the non-QM doesn't react as much every day to the market fluctuations. So you see that this is about the same it was yesterday. It'll probably continue to be about the same, whereas the conventional really kind of yo-yos up and down by the day and even by the minute in some cases. So we love to do this show and propose that most of our borrowers always look to a non-QM option so that everybody has an option, right? We love to do conventional and FHA, but we also love to quote our borrowers an alternative option, which many of our borrowers take advantage of. Now, before we pass it back over to Jose, we always want to go into a couple investment property examples. So at the Mortgage Calculator, we love to do investment properties for our clients, whether they're a first-time investor getting their first rental property or they have hundreds of rental properties. We love to work with them. So let's check out a couple options for switching this up to investment property. We'll do the same scenario, slide this over to 80 LTV, 20% down payment loan, same loan amount, same desired price, one discount point. And we're going to compare our conforming conventional options to our non-QM expanded guidelines options. Remember, FHA, VA, USDA, not for investment properties. So we can quickly do our conforming option, keep everything else the same. It's just going to be investment property. And see what our conventional rates are this morning. So notice when we do investment property, just as I say every day, there are some additional penalties that the GSEs, the government-sponsored entities that insure these loans basically have added. So this isn't something that any of us really have a choice with. The computer is not able to find an option for one discount point cost just because of these extra fees. So we see here a 7.125 rate, but 3 discount points in cost. So a lot of our investors don't mind going up in rate, but unfortunately with conforming, this is probably the highest rate that we can go at this point, and so there's just a lot of fees at those rates. Just that's the way it is right now. So a lot of our investors love to get alternative options, and that's where we love to offer our non-QM programs. Let's see if there's any better options here to go up in rate a little bit to lower the discount points. Not really much action here. You see if we go up to 7.5 rate, there's an option here for 2.875 in discount points. Again, most of our investors want to save discount points so they can buy more investment properties. So no problem, we can quote this up for you, but I always recommend our investors to have both options. A conforming option, if they qualify full doc, amazing, but I always recommend everybody to take a look at our non-QM options, and in particular, for investment properties, let me set back to 80. For investment properties, when we switch up to non-QM expanded guidelines, the best program by far, most popular, is going to be our investor DSCR program. And that's because it actually does not require any income verification. No employment or income verification from the borrower. We're simply going to use the estimated rents from the property in order to determine if it can cover the PITIA of the mortgage payment, right? So we even have options for properties that don't quite cash flow, so it doesn't quite cover the payment. We still have options for that. That would be called a no ratio, where sometimes most of them want a 0.75. And obviously better priced options if the property cash flows better. So you'll see some DSCR options where cash flows greater than 1.5 times will be a little bit cheaper. So we love to do these loans. Please get with our team because they're very tricky. There's a ton of different options you'll see here in a second, but let our team navigate that for you. That's what we specialize in. Now, with all of our non-owner occupied investment properties under non-QM, we're typically going to have a prepayment penalty. So we're always going to price it with a standard 3 years. That's pretty standard. We can do 0, but that reduces our loan options and obviously costs a little bit more. And we can do 5 years, which is also a viable option, costs a little bit less. But for our typical scenario, we're going to have a 3-year prepayment penalty, and that's going to be pretty standard for our DSCR. So let's check out our DSCR programs for the same scenario. Now you'll see here the rates are higher, but our investors don't mind as long as the property cash flows typically, and that's because they're able to save a lot of discount points. So 8.25 rate for 0.975 in discount points. So they're going to save almost 2% of the purchase by using a DSCR loan, and as long as the property still cash flows at a little bit higher rate, most of our investors are happy. So I definitely encourage our investors to Get a comparable quote of DSCR versus conventional and compare them side by side because they're very comparable now. Non-QM is definitely a viable option, especially as the conventional markets react to the general market sentiment. As I always mention, there's tons of options here. So there's dozens of DSCR programs. They vary in prepayment penalty amount, DSCR ratio. So please get with our team to navigate which one of these may work best for you. Some of these at the higher rates that you see may have flexibility, such as using short-term rental income. So if you have a very specific need, we have tons of programs, and we can find the one that fits best for you. So that's it for today's live section. Let me go ahead and switch up the screens, and we'll introduce our topic for today. Pull that back up. So today we're going to talk about land loans. So very common request, very common misconception of how it works exactly. So there are options for land loans out there. These are very hard to find. I know Jose's working on a couple of scenarios here. They're not always easy to find, and they're very unique. So for these land loans, we got to make sure the project fits, right? There's not a lot of loans for speculation and development. So if you're looking for someone to purchase, 100 acres and develop, 1,000 homes, this probably is not the exact product for that. We do have options for that, but it's a little different, right? That's a ground up construction, a whole new ball game, and we're typically going to finance the land with the construction. We're talking today about land on its own. So we did a couple shows before about one-time close. That's for primary homes, for conventional loans that allow us to purchase land and build a spec home on it. That's a one-time close construction loan. We've also talked about our ground-up construction for investors. So that's where we will, again, for an investor, maybe they already have the land, but we're going to finance the land with the build of the spec home for an investor, right? And that would be typically like a fix and flip commercial ground-up construction. So we had an episode I think it was last week or the week before on that as well. So there are very different options to include a home or an end loan with a home on it. That's not what we're talking about today. What we're talking about today is land on its own, sitting there, no structure, no actual any value besides just the land. So this isn't what you might think it is. I know a lot of us get requests for development, right, where they want to build something. That's ground up construction. We're talking about just the land right here. Land sitting on its own. Can we finance a piece of land sitting on its own? And Jose is going to explain here a little bit. There's kind of a very different categories, right? There's land on its own for recreation. So those would be things like hunting. You need to buy 100 acres for a hunting farm, right? Maybe there is structure on it, but it's more like a cabin or something like that, right? Not something that you can really get a home loan for, right? So there's recreation type stuff. And then there's what we talked about before, development, but just the land, right? Someone wants to buy land to then, get some permits and get some, stuff put together to then move on to the project, right? So they're not ready for vertical, right? They're doing horizontal, they're doing entitlements, they're doing all that stuff. So they need to hold the land when they're getting their entitlements and getting all their permits in place so that then we can do the ground up construction loan, refinance their land into the end construction loan and finance the vertical construction. So what we're talking about today is land alone. Typically that's going to be two categories, some sort of recreation type category and then some sort of development type category. But again, it's just the land alone. We're not talking about structure here, guys. So I just want to get that out there. I think that's about it for the intro. Jose, are you ready there with your examples?
Yes, sir. Just tidying up a little bit here. So we got two examples here that we're going to deal with. Okay, let me make sure I got everything here. Yes. All right. So two of the examples we're going to deal with here. One is where you're buying the land for a future build for investment, like what you were mentioning. They don't yet have what they need, entitlements, stuff like that. So let me pull it up here. So obviously that's not going to be a long-term loan, but let me share it here with you all a minute. All right. So if you can pull that one up here. I'm going to talk about the two different scenarios that we have here. One is a land purchase for investment, right, where they don't have the entitlements yet, right? So there are options out there that's very similar to basically a hard money loan. But this is the reason that most people are looking for land. Um, and now, what I mentioned about they don't have the entitlements yet, okay, they could be buying a piece of land that doesn't has maybe it's not. It's like a pure speculation move. Maybe it's not yet totally authorized. That's what I mean by entitlements to build a single family subdivision or something like that. So that's going to take some time to get different zoning changes, variances, whatever it is that they would need. That would not allow you to do a regular land loan like what Nick was mentioning, where we're going to combine the land with a construction loan. So if you got a piece of land that is zoned single family or two family, whatever it is, and you're going to apply for a construction loan to build that type of a home on a property that's already entitled to do that, that's a quick deal to get, right? You do the construction to permanent, the land acquisition is included in the purchase. You get your plans and you close in 30 days, maybe 45 days. If it takes a little bit longer to do your due diligence there. With this type of a scenario, you may need a year and a half to properly prep the land to fully get the benefit of the investment. So we do have options there where the investor can go, and again, you're looking at rates similar to what you're going to have in hard money and stuff, because this essentially is like a bridge loan, right, where they're giving you the money for a year and a half, 2 years, and you just set it up and get it done. But there has to be some type of an exit strategy here. They're not just going to lend you the money because you asked for it, because land is very speculative. I mean, they know there's going to be a good return, but they want to know you're going to be able to meet the objective. So they will vet the deal a little bit. But again, it's very, it's a type of bridge loan where they are not going to qualify the borrower so much on the income, but on the deal and the credit and the experience and all of those other components that usually come into play when we're sizing up like a fixed flip deal. Their sizing does the is there meat on the bones, right? Is this gonna actually reach fruition at some point, or is this person going to get tired and just walk away? So in this type of a scenario, it's not going to be a high LTV. This now again, without being able to be too specific here, because again, these deals are individually sized, right? They're going to size up the location, they're going to size up the borrower, as well as the borrower's credit and experience, all that kind of stuff. And in the end, it's going to be 50, maybe 60% loan to value. And as long as we're all aware of that requirement and we set the proper expectations to the deal and to our borrower, then we should be good, right? We can't have them thinking they're going to finance 80 or 90% of this, or you can't be thinking that's going to be possible, and then you're going to go on this wild goose chase for a week or 2 weeks, and then nothing, right? So just know what the expectations are in this type of a scenario, because this is probably one of the most common scenarios that we see. The investor wants to get a big piece of land and wants to do a subdivision.
So what's
So
the leverage on this one? This one's 35.
60%.
Okay. Can you scroll
I
down to the leverage?
figured this one at
There you go.
60%, but chances are 60% would be like on the best case scenario of this spectrum. It could be as low as 40%. They're going to size up the deal, and they're very picky of where it is, and what is the prognosis for future in the area, if it's up and coming or years away still. So those are all things that have to get taken into consideration, because nobody wants to lend on a dud, something that's not going to happen. So I guess the main takeaway from this is to understand what the expectations are and properly convey those so that your borrower is content when you come up with the options that are going to fit what you told them was going to happen. Don't make them think, oh yeah, sure, 80%, I'll get it for you, and then it's not going to happen. And if maybe you would have set the expectations properly from the beginning and they would have accepted it, then you could have proceeded to do what you got to do. So now I'm going to go to the other side of the spectrum here is something that most of you may sorry about that something that most of you may not know, is land purchase for agriculture. There are a lot of options for this, and that's what Nick was mentioning. The farm. So we can finance hobby farms, for example, but it cannot be like a commercial endeavor, totally investment. I guess I would compare it similar to like an SBA loan. It's a commercial loan for an owner occupant that gives high LTV in consideration for the business owner that's occupying their location that they own, right? So this is very similar to that. So you can get 75% LTV up to $500,000, and above $500,000 loan, it is 65% LTV. So look at the higher LTVs that you're getting there, right? This is a brokered product. Now this for it to be considered a hobby farm, it needs to have at least a 10-acre minimum, right? So, and the maximum contributory value of the buildings and improvements, this is critical, cannot exceed 50% of the value that you're financing. So this is the opposite of a loan where they're telling us in many cases, your maximum could be 5 acres, your maximum could be 10 acres. They may only give value on the first 5 acres. A lot of different things you hear for conforming loans and for non-QM loans. Well, here it's just the opposite. They want it to be more based on what it actually is, agriculturally based. But again, they do have some exceptions. No greenhouses, no Christmas tree farms, no tree farm in general. This is not for a horse ranch. It's not for equestrian properties. This is ag. So I guess they're trying to base it a little bit on uh, maybe a little bit more agricultural production, gentleman farmer, in the U.S. Whatever it is, they want the highest and best use of the land to be agricultural or agricultural slash rural residential. So again, this is totally puts a different hat on, different mindset on how you are going to approach the loan when you are specifically looking for a land purchase for ag where there's also structures on it or no structures on it, and it's just pure ag. So it is something possible to do for our gentlemen farmers out there that want to have their home that's also their farm.
Alrighty, go ahead, take your example off there, bring it back in. All right, cool. Well, thank you, sir. You want to close it out then, Kyle?
Yeah, absolutely. Yeah, there's some questions as well, but I don't want to go too much over time here. But definitely some questions in there if maybe you want to touch on one or two
All
of
right, yeah, let's
those.
pull up a couple of these, Jose. So 40 to 60 LTV, depending on loan scenario. Pretty accurate.
Yes, that's now for the investment land. For the pure speculation type deal, yes, usually 40 to 60%.
And then David had a good question here. Client owns land, doesn't want to develop the land, but to use the land as collateral to borrow money to do fix and flip projects in Arkansas. Do we have something for this scenario? So
So
you can
what
do
you're
cash
talking
out
about?
on land. That's what you're asking for, I think, right?
Yeah, I mean it's a refi on land, right? Cash out refi on land. So yeah, I mean depending on what type of land it is, again, you mentioned they're going to want to vet the deal, right? They're not just going to say, oh yeah, you got land, let me give you money, and it's a 2 or 3 year loan, because whatever you're going to get like that, if it's no purpose on the land other than I want to use it as collateral to borrow money, if they do it, that's going to be low LTV because it's high risk. I mean, you're just encumbering the land and planning on not doing anything with it. So, but it would be, you're looking at a bridge loan at best on that.
Yeah, so I would do a cash out refi. You don't want to do any cross collateral, and I don't think any cross collateral will grow across land. We have some cross collateral loans or portfolio loans, but that's for properties, right? Not land. So we did that the other day. Another question here. Ag exemption. I think we kind of went over that. That was your actual example, right?
Yep.
So good to go there. And this one's a good one. What's a minimum loan amount for the land loans? Definitely varies by program, right?
Yeah, that depends on what they're looking at here. I'm not really looking at a minimum per se, but I mean, you're looking at 10 acres minimum. Now they are talking about minimum loan size here on this one option of $500,000.
Is that the speculative option or the
No,
recreation?
that's the ag option. 10 acre minimum, uh, and $500,000 minimum loan size when it is a farm.
So, in other words, it depends, right? So, there would be a different minimum loan for development
Yeah,
type.
depending on the use of the property, uh, what's on it or not, then they're going to structure the deal accordingly.
Yeah, these are going to be basically almost like commercial deals, guys, right? Where you have to each one sizes up individually, right? So, a little difficult to just kind of lay out a loan program because it's all case by case.
Now, what I can say about it, I have to really emphasize that the highest and best use, if you're going the ag land purchase, the highest and best use due to what it is, even though the highest and best use wouldn't be what we would normally consider, the highest and best use, because everybody thinks, if it's single family residential zoning is going to have higher value, or commercial zoning higher value than ag. But for this loan, it has the highest and best use needs to be agriculture. If the highest and best use is, for example, rural residential without agriculture, they won't accept it for this program.
Yeah, that's a collateral trading we'll have to do later, Jose. Get in depth in that. Let's take one more question. We got a good basic question here for you. Minimum credit. How about on that ag program? What's the minimum?
710.
710.
Yeah.
Little tighter on the credit box there, guys. These are weird loans, right? These are unique.
Yeah.
So
I don't know how they reach 710. It
that's
could
a
be
strange number to land
700,
on, right?
720. No, 710. There's a reason, though, I'm sure.
Yeah.
So yeah, you see here, we'll go ahead and wrap it up, and you see here very difficult loans. And here at the mortgage calculator, that's also something we can use to our advantage, right? Because our loan officers are going to consult them through the process, and we're going to figure out the best option. We got multiple options when a lot of loan officers wouldn't even attempt that, right? And so they either don't have the outlet for it or are not going to attempt that. And that's where here at the mortgage calculator, we can take advantage of that, right? And be the ones to walk people through these scenarios and find something that works for them, because other people aren't going to do that. So with that being said, let's wrap it up here. We do this every day at 11 a.m. Eastern time, every weekday. So tune in as we go through the rates and show you the rates every day. You can see how they're going up and down and how the market is. And then we do a deep dive into a topic every day, just like we did land loans today. We do a different topic every day so we can go through and learn some about these different programs. So thank you, everybody, for tuning in, and hopefully we see you tomorrow at 11 a.m. Eastern time.